Hello and welcome to this week's edition of Tax in 10 with me, Rachel de Souza, and Andrew Robbins. We are both tax partners in RSM's London office, and between us we have over 50 years of experience in advising on tax matters. This podcast or vlog is aimed at private client professionals, fellow tax practitioners, bankers, lawyers, trustees and so on, all who have a focus on private clients and private wealth. As always, do let us have your feedback or topics you would like us to cover in the future, and we can be contacted at rachel.desouza@rsmuk.com or andrew.robbins@rsmuk.com. Today, I think what is going to be a good topic for us to discuss is government debt, because I have discovered, along with probably with the rest of the population, that government borrowing is at an all-time high. And in June 2020, it hit 1.95 trillion, and 1 trillion is a million. But effectively, our government debt is now larger than the size of the economy. Not only that, it doesn't seem to be that there's any slowdown in the amount of spending that the government is currently undertaking. So our government debt is going to continue at these extraordinarily eye-watering levels unless serious measures are taken. Now, there's been lots of talk about how the government should balance the books. And the biggest question that I have been asked is whether CGT will change. What do you think?
I think I agree with you that it's the question that I'm being asked all the time at the moment is, are we going to see an increase in CGT? And I think one of the reasons I'm being asked that is because we have been seeing these sort of strategic leaks coming out. So you read the Sunday Times, which is always a good source for government-approved leaks on Treasury matters.
Yeah.
Where they're floating the idea that CGT could be increased to a rate equivalent to income tax.
Mm-hmm.
That could raise a fair amount of cash. But the real question is, how much would it raise and what difference would it make? So I've done a little bit of digging.
Mm-hmm.
And the government own figures show that for the year to 5th of April 2020, government revenue was about £772 billion. Of that revenue, inheritance tax accounted for about £5 billion, and capital gains tax accounted for about £11 billion. Now, £11 billion sounds like quite a lot of money, but not so much out of 770 billion. So it amounts to about 1.5% of the government's total tax take. Now, if we were to double the rate of capital gains tax from currently its maximum rate is 20%, so let's say the government increases it to 40, it wouldn't actually double the tax yield, because a lot of people don't pay capital gains tax at the top rate anyway. So just doubling the rate doesn't automatically increase things. We have an annual exemption, annual allowance, currently £12,300. And for the vast majority of people, any capital gains they might make in a year will be within that. So the rate of tax is irrelevant because they're not paying it anyway. But let's pretend that we could double the amount of CGT by doubling the tax rate. The effect of that in isolation would be that CGT might raise £22 billion instead of £11 billion, and that might slash spending on debt and that side of things by increasing the take from 1.5% to 3% of the government's total tax yield. I mean, it's not nothing, but it's not far off nothing when it comes to how are we going to deal with total debt. To me, raising rates of CGT as a solution, or as even a gesture towards a solution of dealing with the level of borrowing, it's almost laughably ineffective.
But let's say some extra tax is raised, and this amount you've banded around 11 billion, plus let's say a few billion from something else. Given the size of the total government debt now, how long is it going to take us to pay off that total government debt?
On my fag packet calculation, if the Treasury increased taxes by, let's say, 15 billion a year, which it could do by doubling the rate of capital gains tax plus halving the rate of the annual allowance for CGT, for example.
Okay. Yeah.
So that more people are paying CGT at the bottom end.
Yeah.
And people are paying a higher rate of CGT. You might manage to raise 15 billion by doing that. And that 15 billion would all count towards reducing the debt, so we purely spent it on debt reduction. If we go from your 1.95 trillion pounds of debt, it would take mere 130 years for us to pay off the debt using that increased taxes.
So in effect, it's a drop in the ocean.
The tax increases on CGT are really not going to make any difference to anything.
No, whatsoever. Okay, but we haven't talked about income tax or national insurance, and that is, if I remember rightly, that's by far the biggest revenue raiser.
Income tax and national insurance, if we pull the two things together, is about 45% of the government's tax yield.
Right.
So it's about 350 billion. So it's a much bigger prize. But of course, if you want to start playing with that, the first thing you're going to get is the Chancellor's triple lock, saying he's not going to increase income tax.
Yes.
Pensions are locked in and national insurance isn't going to rise. That was in the last manifesto. So economically, it would make sense to target those things. Politically, might be quite tricky.
We could raise the level of CGT, but that's really not going to help us enormously. We could raise the level of income tax, but there are some political reasons why that might be difficult. And even if we did, this extra money that we're raising is not going to make a huge dent in the amount of debt that we still have to pay off. So at the moment, we're reckoning 130 years if we only raise 15 billion extra each year, but obviously that will come down if we can raise a lot more. One of the stats that came out that we've looked at is that corporation tax could rise, for example. One of the analysis was that, at the moment, corporation tax is at an historically low rate of 19%. And there's no reason why that could not rise by 5%, let's say, to 24%. And the statistics say that will raise another £17 billion, but that's by 23-24. So that's still a number of years before you raise, any sort of meaningful amount. So I think where we end up with is that whatever tax raising measures are implemented, there will still be a significant debt pile in at least 60 years' time, if not 70, 80, 90 years' time. So that just leads me to say, is this the new normal?
Well, it may be that it is, but you would hope that there might be some other alternatives. With that in mind, I have the perfect solution to all of this. We just print more money.
Hang on. I just sense a little problem with this. I have visions of the likes of Venezuela. No food in the shops and people starving and so on.
No, I'm not saying that you don't carry on doing all of those things. I'm just saying that you print money and make the problem go away. I know you're going to say stuff like inflation running out of control and currency deflation and things.
Yes.
But that's just doom mongering.
I don't think it is quite. But there is, I think you've got a sensible point in there somewhere, but I'm not quite sure where at the moment.
Well, I think realistically, maybe we don't print 1.95 trillion pounds worth of £5 notes in order to pay off the debt. Monetary easing, putting more money into the system, does provide more money into the Treasury. And it actually, the side effect you would expect is to increase inflation. I think you and I are both old enough to remember inflation rates,
well into double figures
comfortably. And that's not a great place to be. But maybe, an inflation rate, let's say, of 5%, the effect of that over time is to reduce the effective value of the debt.
Yep.
And so rather than concentrating on tax raising measures, maybe about can we kick the can down the road for long enough at a moderate level of inflation so that the amount that the country eventually has to repay on these loans in real terms is much lower than it is today, simply by the passage of time.
Yeah, and that makes sense, to people of our generation. I think obviously, people of a younger generation will not be used to inflation. So there's obviously a political issue there. I think the other area is, again, people of our generation, or certainly tax professionals, will remember the 3.5% war loan that was issued in 1917. Now, this was just the way that the government got the population to provide it with funds in order to fund World War I. And I'm sure you'll be astonished to hear that war debt, so the 1917 war loan, was only fully paid off in March 2015. So we have precedent for some kind of loan which is outstanding, well, in that case, for just under 100 years. And if we had some COVID loans, which could pay interest at say 1.5%, you'd have that the inflationary perspective over time. So again, the real value of it will be decreasing as the years go by. And the government can use it as long-term funding rather than taking sort of short-term debt of 5 or 10 years, which then will have to be refinanced at the prevailing rates at that time.
I think that's a really good idea, actually. The other part that appeals to me there is the government is locking in your example, your 1.5% interest rate. So the actual value of the bond may fluctuate. Your yield will vary as it's traded on the market, depending on prevailing rates, but the government will always be paying 1.5%.
Yeah.
So you've got a very long-term debt with a very fixed, predictable cost. Maybe rather than me just printing my money, you going out and borrowing from the general public. I mean, your war loan you talked about, if I think about it, that was a debt for individuals. You did your bit towards the war effort by buying
the debt. Yeah.
You do your bit now towards COVID by putting some money into some COVID loans. I actually rather like that.
Yeah, I think so. But I think, look, we've done it again. We've solved the world's problems. So it's going to be a combination of moderate inflation, whatever moderate might be, and COVID loans. So now that we've done that, are you going to be off to the Treasury to promote this?
I will pack my briefcase and disappear as soon as we finish this call.
Fantastic.
In our tradition of finishing off with something completely unconnected, I wanted to recommend the novels of Marcia Muller. And Marcia Muller basically created a genre back in the 80s when I was growing up, and there was a new wave of feminism coming to the fore. There were lots of fantastic novels being written by women from a female perspective in a way that we really hadn't particularly seen before in genre literature, things like detective novels. And Marcia Muller was the first to do this. And the novels stand out fantastically well today. And it's a real interesting sort of look back at the world as it was as a woman in work back in that 1980s period.
Okay. Oh, I might give that a go. And with that, that brings this week's Tax at 10 to an end. So as I mentioned previously, please feel free to contact us. It's rachel.d'souza@rsmuk.com or andrew.robbins@rsmuk.com. And we welcome any comments or feedback you may have. Until next time, bye for
Thanks a
now.
lot. Bye.